Thank you, Prashani, for that introduction. We expect the tile sector companies within the RCL group to record strong earnings given the current operating environment. During our presentation, we will cover key drivers of growth, an industry overview, the company performance and earnings expectation, as well as the valuations. So in a low interest rate environment, we expect construction activities to pick up. Interest rates have been steadily declining with AWPLR at 5.66% as at the 21st May 2021. A maximum interest rate of 7% per annum has been imposed for housing loans for public and private sector salaried employees and is expected to drive residential construction activity. Large-scale condominium projects and tourism-related projects are expected to recommence in the second half of the financial year 2022. The growth in construction activities are expected to impact the tile sector positively, but with a time lag of 8 to 10 months. The revenue growth witnessed during a low interest rate period has been significant for these counters. During the first quarter of financial year 21 through to the third quarter, where average weighted prime lending rates declined from 8.65% to 5.83%, all counters experienced a significant growth in revenue in comparison to their corresponding period of the previous year. RCL recorded a 46.73% growth in the third quarter in compared to the previous year. LWL recorded a 55.99% growth. Tile recorded an 86.25% growth, while Swisstech recorded 13.45% growth in the third quarter. This trend was historically witnessed even during 2014 to 2016, where AWPLR was declining to a single-digit level. The cess rates have been revised. An agreement with the Ministry of Finance and the local ceramic importers was reached. For tiles, the revised cess applicable on imports amounts to 50% or 490 rupees per square meter. For sanitary ware, a flat cess rate of 75 rupees per kilo for squatting pans and 155 rupees per kilo for other sanitary ware will be charged going forward universally. Previously, some sanitary ware products were not being charged cess, while some others were charged 15% or 40 rupees per kilogram. Although an agreement has been reached between tile importers, local manufacturers, and the Ministry of Finance, the ban continues to be in place and is expected to continue through financial year 2022. So this is just a comparison in terms of what the cess rates that was applicable previously and the revised rates. So for tiles, previously the cess applicable was either 50% or 183 per unit, which has since been revised to 50% or 490 per square meter, while the custom import duty remains the same at 15%. For sanitary ware, the cess has been revised from 15% or 12 rupees or 40 rupees per kilogram to 75 rupees or 155 rupees per kilogram, depending on the category. Even after the import ban has been lifted, we believe that the competition from imports will be limited. Smaller players will not be able to obtain the supplier credit for 180 days, given the larger volume required. The longer credit period will open importers to withstand possible currency depreciation. Importers are also expected to face challenges of delays in inventory mobilization due to congestion faced in global ports and continued higher freight costs, which has surged over 4 to 5 times year on year. Several large importers, namely Navin Ceramics, Ranjana's, Fazal Ceramics, and Manamperi, have entered into long-term OEM contracts with RCL and Lanka Tiles. This graph represents the increase of the freight charges over the last year. Going forward, local players are expected to dominate the market. In the past, domestic tile players faced intense competition from imported tiles, which were priced lower than locally manufactured alternatives. In 2019, the demand for tiles amounted to 25.3 million square meters, which was a decline of 15.7% over the previous year. During this period, demand shifted to low-cost imports, resulting in an increase in importers' market share. The importation of tiles has been banned from May 2020, which further supports the domestic manufacturers. The ban continues to be in place and is expected to remain through the financial year 2022. The surge in demand for locally manufactured products owing to the import ban has resulted in demand outpacing supply. Given the revised cess structures on imports coupled with the excess demand, leading local manufacturers are expected to enhance their existing capacity. RCL and LWL plan on increasing their capacity by 40% and 167% respectively, while unlisted tile manufacturer Mac Tiles is also expected to increase capacity. By 2024, it is expected that local manufacturers will cater to 95% of the domestic demand. So these represent the market share of the local players prior to the import controls. So local players were controlling 53.5% of the market, while importers had 46.5%. Post-import controls, the local players controlled 92.4% of the market, while the importers controlled 7.6%. And post-capacity expansion, we expect the local players to control 95% of the market, with importers' market share being at 5%. Based on industry personnel, Rosal currently is the market leader with a 31% market share. Lanka Tiles has 29% market share. Lanka Wall Tiles has 6.4%, and Mac Tiles has 26%, while importers have approximately 7.6% market share. Moving on to the aluminium sector. We expect the aluminium sector to record strong performances during the low interest rate environment, which fuels housing and commercial building construction. During the third quarter of financial year 14 through to the fourth quarter of financial year 16, AWPLR was at single-digit levels and was ranging at about 9%. The number of housing approvals grew at 12.9% year-on-year. During this period, the tile, flooring, and aluminium sector recorded significant growth. Although housing approvals have been impacted in the last year owing to the lockdowns, we expect the sector to benefit from about mid-2022 with an increase in the housing approvals. Given the expected construction industry revival, the sector could record similar growth from financial year 22 onwards. Although due to aluminium price increases and expected currency depreciation, margins may remain static. The aluminium futures prices have increased over 58% during the last year to $2,405 per ton. Approximately 30% of aluminium's raw material requirement of Swisstech is supplied domestically. In November 2020, a ban on export of aluminium scrap was imposed to provide the local industries with sufficient raw materials for production. Exportation is still possible via a license and is subject to cess. To negate the impact of price increases and currency depreciation, local players are expected to increase their prices by 10 to 12% in the first quarter of financial year 2022. Leading industry players such as Swisstech are focusing on strengthening their distribution channels and increasing sales of value-added products to drive sustainable operating margins. Within the aluminium segment, it is expected that margins of leading local manufacturers will improve owing to higher capacity utilization in the fourth quarter, which is primarily driven through volume growth. Currently, aluminium extrusion imports are banned, and aluminium alloy products are permitted to be imported either under 90 or 180-day credit period. The importers' market share amount to approximately 7%, and some importers may find it difficult to meet the necessary credit requirement to obtain a long credit terms from their suppliers. In terms of the market share, Alumex controls 37% of the market, while Swisstech controls 30% of the market. Lanka Aluminium Industries has about 17% market share, with Hemelco at 10%. Importers have about 7% of the market. I would now like to hand over to my colleague Hasita to walk you through the company performances and valuation.
Thank you, Divya, for the update on the tile and aluminium sectors. Now we will dive deeper into the performance of Swisstech, Lanka Tile, Lanka Volatile, and Rossell. Starting with Swisstech Ceylon. Swisstech Ceylon is into the manufacturing of flooring products such as mortar, grout, and also into wooden flooring installations. And also it has exposure to aluminium through its holding in Swisstech Aluminium. Let's start off with the revenue. Just looking at the revenue contributions for the first 9 months of financial year 21, we can see there was a increase in the contribution from aluminium and a reduction in the contribution from from the flooring segment. We can attribute the increase in the aluminium segment, the price increase that was implemented in the second quarter of financial year 21, where the leading players in the industry collectively increased price and made a decision not to undercut each other. Which resulted in profit margins improving during the financial year compared to the loss-making years in financial year 19 and 20. As you can see, profit margin for aluminium increased from increased to 8.7% from a loss of 1.7% in FY20. The profit margins for the flooring segment decreased from 20.2% to 17.7% during the first 9 months of financial year 21. The reason for this was the wooden flooring installation at Cinnamon Life came to an end in financial year 20. That reduced the margins for the segment. Just looking at the installed capacities for the two segments, at the Tumpe factory, Swisstech has an installed capacity of 700 metric tons per month, whereas at the flooring factory has an installed capacity of 45,000 metric tons per month. The utilization levels for the flooring is 81%, and for aluminium it is 87%. Just moving, just to give you a brief introduction and information on the various flooring item products in the portfolio of Swisstech Ceylon. As you might be aware, they are predominantly a manufacturer of mortar, adhesives, and grout. With the consumers currently prefer and moving towards larger tiles, the demand for grout has decreased, whereas the demand for mortar and adhesives as a result has increased significantly. Swisstech currently sells around 160 million worth of mortar a month from the second half of financial 21. That amounts to around 20,000 bags per month. This is around a 30% increase per month compared to the second quarter of financial year 21. The increase was brought about by the latest by adding RCL to Swisstech's distribution network, where Swisstech is now distributing its product range via its Rosa's distribution network, in addition to the Lanka Tile network as well. The grout market currently is around 80,000 bags per month being sold, which amounts to around 24 million sales per month. Swisstech also won a contract to provide the wooden flooring installation for Prime Grand's luxury apartment. Contract value is around $1 million, and usually the GP margin for wooden based flooring is around 45 to 50%. So this should boost profitability in the second half of FY21. Looking at revenue projections for FY21 and FY22, we forecast revenue of 6.3 billion for FY21, and we expect the aluminium segment to contribute significantly in FY22, which will increase revenue by 10.9% to 6.985 billion. In terms of net earnings attributable to the shareholders, we forecast 548 million in FY21 and 650 million for FY22. Again, predominantly the contribution from the aluminium segment. The EPS for the year FY21 is 4.01, and we expect this to increase to 4.75 in FY22. Moving on to the valuations of Swisstech, we assign a target price of 38 to the share, which provides an upside of 27.93%. Swisstech is currently trading at 7.41 times FY21 earnings and 6.25 times FY22 earnings. The FY22 multiple is approximately a 4.78% discount to the broader market multiple of 10.56 as per the latest figures available on Bloomberg. We arrived at the target price of Swisstech using a forward multiple of 8 times. 8 times multiple is a 24.24% discount to the broader market multiple of 10.56. With regards to the upcoming fourth quarter earnings, we forecast an EPS of 1.91 rupees per share, which amounts to a 554.4% increase on a year-on-year basis and a 58.2% increase on a Q-on-Q basis. Historically, Swisstech has traded at lower multiples due to lower liquidity associated with the share, as well as the losses incurred on the highly competitive aluminum segment, which dampened the sentiment from the future earnings. Now, with the aluminum sector turning profitable and expected to increase contributions in FY22, we expect the earnings to outperform the earnings growth of the broader market and trade at a higher multiples to historical figures. The dividend yield forecasted for FY22 is 5.6%, whereas for FY21, dividend yield expected is 4.72%, based on the 35% dividend payout ratio. Moving on to Lanka Tiles. Lanka Tiles, other than business of manufacturing and trading ceramic tiles, have also has an associate stake in Swisstech Ceylon to a 47.8% holding. As Divya mentioned earlier, due to imposing of an import ban on low price imports, demand for tiles outpaced the local production. In FY19 and FY20, the demand for construction material decreased significantly. But even with the decrease in demand, management made the decision to operate at around 97% capacity utilization at its Randala plant, which resulted in a significant increase in built-up inventory. That paid dividend because when demand outpaced supply, the company was able to sell down its built-up inventory, resulting in significant increase in revenue, as well as increase in profit margins due to economies of scale. As you can see, the profit margins increased from 11.6% to 17.4% during FY21, and the margins are expected to even increase further when you account for the full year's earnings in FY21. Looking at the forecasted revenue for FY21 and FY22, we forecast revenue figure of 12.5 billion for FY21, and we forecast a 15% reduction in revenue for FY22. This is due to the fact that Lanka Tile have exhausted its built-up inventory in entirety, and as a result, will incur reduction in revenue in FY22. The PAT attributable to equity holders is forecasted at 1.9 billion during FY21, and we expect a reduction of approximately 8% in FY22 to arrive at 1.82 billion. The forecasted EPS for FY21 and 22 is 7.49 and 6.86 per share. Moving on to valuation segment, we have arrived at a target price of 61.8 rupees a share for Lanka Tile, which is 27.16% upside from current trading price. Tile currently trades at a multiple of 6.48%. Sorry, 6.48 times FY21 earnings and 7.08 times FY22 earnings. The FY22 earnings multiple is at a discount of 32.94% to the broader market PE of 10.56. We arrived at the target price using a multiple of 9 times FY22 earnings. The 9 times multiple is a discount of 14.77% to the broader market PE of 10.56. We expect the counter to trade at a discount to the broader market given the risk associated with the possible removal of import restrictions as well as changes in protection tax structures on tiles through high duty and cess rates. We have assigned a higher multiple to tile compared to historical figures due to the increase in demand created through the imposition of the import ban, as well as the uptick in demand through the increase in residential construction due to a low interest rate regime currently in place. The forecasted dividend yields are 4.63 and 4.24% in FY21 and FY22. Based on a payout ratio of approximately 30%. Moving on to Lanka Volatiles. Lanka Volatiles has a controlling stake in Lanka Tiles. It also, through Lanka Tiles and direct shareholding, has a controlling stake in Swisstech alone. It has exposure to plantations as well as packaging at Unideal through valuable plantations. Again, as mentioned previously, with regards to Lanka Tile, Lanka Volatile to experience similar growth in revenue in FY21, similar to Lanka Tile, where the first 9 months revenue exceeded FY20 as well as FY19 full year figures. And due to the increase in sales from tiles, the composition of revenue for the tile segment increased from 55.6% to 65.9% in FY21. The contribution from the plantation, packaging, and aluminium segments reduced as a result compared to FY19 and FY20 figures. Moving on to the operational overview, it is significant to know that management hope to add additional 10,000 square meter capacity to its MIPE factory during FY23. We expect the total 10,000 square meters of new capacity to go live at the start of FY24, resulting in Lanka Volatile's total installed capacity increasing to 16,000 square meters a day. Similar to Lanka Tile, Lanka Volatile's PBT margins increased significantly compared to the last 2 years due to the significant increase in demand and ability to draw down on built up inventory. Also, the plantation segment losses reduced from 25.7% to 4.9% in FY21. Also, the printing segment will profits increase from 7.6% to 8%. And as mentioned before, the aluminium segment turned around from a 1.7% loss to a profit of 8.6% in FY21. First 9 months of FY21. Moving on to the valuations and forecasts. We forecast a total revenue of 29 billion for FY21, and we expect a slight reduction in revenue of to amount to 28.6 billion in FY22. This is mainly as a result of the reduction in sales from Lanka Tile. We don't expect Lanka Volatile to incur a similar reduction as it has sufficient inventory to cope up with demand in FY22. Moving on to profit attributable to equity holders, we expect a profitability of 2.75 billion for FY21 and profitability of 2.678 billion in FY22. This is a 2.71% reduction due to the lower revenue during the year. In terms of EPS, we forecast an EPS of 10.09 for FY21 and 9.81 for FY22. Moving on to valuations, due to the significant increase in earnings, we have arrived at a target price of 88.3 rupees a share for LWL, which provides an upside of 78.38%. In terms of multiples, LWL is attractively valued at 4.91 times FY21 earnings and 5.04 times FY22. So this is the lowest multiple across the four counters at present. FY22 earnings multiple of 5.04 is a 52.27% discount to the broader market PE of 10.56. Similar to the Lanka Tile, we use a 9 times FY22 earnings multiple to arrive at the target price of 88.3 rupees a share. Then, similar to Tile, as mentioned before, this discount is 14.77% compared to the broader market PER of 10.56. With regards to Q4 FY21 earnings, we forecast an EPS of 4.89 rupees a share, which amounts to a 1,505% increase on a year-on-year basis, and a 28.9% increase on a Q-on-Q basis. Also, as mentioned before, LWL is planning on adding 167% increase in installed capacity by the start of FY24. Similar to Lanka Tile, we feel the share, the premium assigned to the multiple compared to historical multiples is justifiable, given the protected nature of the industry, as well as the uptick in residential construction in the low interest rate environment, and the planned increase in installed capacity boosting profitability in the future. Also, in terms of PBVs, the share trades at an attractive 0.95 times FY21 PBV and 0.84 times forecasted FY22 PBV. Dividend yields are 6.11% and 5.95% for FY21 and FY22 respectively, based on a dividend payout ratio of approximately 30%. Moving on to the PARQ Royal Ceramics, you can see they have associate stakes in highly profitable LB Finance as well as Delmage. It also has controlling stakes in Lanka Ceramics and Lanka Wall Tiles, and through Lanka Wall Tiles, it has a controlling stake in Swisstech as well. Similar to Lanka Wall Tile and Lanka Tile, RCL's total revenue for the first 9 months almost equals the total revenue for FY20 as well as FY19. Again, the contribution from tiles has increased significantly compared to historical figures. In the first 9 months, the contribution increased to 70.7% compared to 64.8% in FY20. The sanitary ware, plantation and packaging, as well as aluminium segmental contributions decreased as a result of contribution from tiles increasing. Moving on to installed capacities, currently RCL has an installed capacity of 10,000 square meters a day at Corona, running at a 99% utilization, and 5,000 square meters a day at Heligood, running at a utilization of 95%. We expect the company to add additional 6,000 square meters a day of installed capacity during financial year 23, which will go live at the start of financial year 24. Again, similar to LWL Tile, the profitability margins for tile increased to 17.2%. Sanitary ware increased to 9% from 6.4%. And as mentioned in regards to LWL, the plantation, packaging, and aluminium segments all improved compared to the previous year in terms of margins. Moving on to our forecast, we forecast a total revenue of 44.4 billion for FY21 and 44.79 billion for FY22, which is a slight increase compared to FY21. The profit attributable to equity holders, we expect earnings of 6.14 billion for FY21 and a 5% increase to 6.44 billion in FY22. This results in an EPS of 5.54 in FY21 and 5.82 rupees a share in FY22. Moving on to the valuations, we have assigned a target price of 58.2 rupees a share in FY22. Based on FY22 earnings, is an upside of 59.02%. RCL currently trading at 6.6 times forecasted FY21 earnings and 6.29 times forecasted FY22 earnings. The FY22 earnings multiple of 6.29 the currently trades at is a discount of 40.42% to the market PER of 10.56. We arrived at target price of 58.2 based on a 10 times multiple on FY22 earnings. We have assigned a higher multiple to RCL as it has by assigning a controlling premium on companies such as Swisstech, Untitled, and Volatile. The discount associated to the 10 times PE is 5.3% to the broader market PER of 10.56. The forecast for Q4 FY21 EPS is 2.55 rupees per share, which amounts to a 330.8% increase on a year-on-year basis and a 40.6% increase on a Q-on-Q basis. Similar to Tile and LWL, RCL traded at lower multiples historically due to the contraction of the construction sector as well as competition from low price imports resulting in lower margins. But with the change in the operating environment and profitability increasing and demand increasing from the lower interest rate regime, we expect the share to trade at a premium going forward. We also forecast a dividend yield of 6.56% for FY21 and 6.36% in FY22 based on a dividend payout ratio of approximately 40%. So that basically covers our valuation summary on the four counters. But now we will open the floor for questions and we'll answer whatever questions you have. Thank you.
We thank you, Hasita, Divya, and the analysis for the valuable insight of the tile sector. Now, can Shihan Mendes, AGM of Capital Trust Securities, read out some of the questions which have been sent through the chat by the audience, please?
Thank you, Prashani. Thanks, Hasita, Divya, for your valuable insights on the tile sector. And we would like to now open the floor for any questions. You can use the chat to send in any questions to us. There were a few common questions that were asked. I would like to draw your attention to that. One of the questions was on the valuations. Are they justifiable? Because historically, these companies have traded at low PE multiples. Therefore, is it reasonable to value them at maybe 9 to 8 times PE multiples? Hasita, would you like to answer that question?
Yeah, sure, Shan. So let me just break it down company-wise. So let me start off with the sustainability of earnings for Swisstech. We really expect the aluminum segment to drive the growth for Swisstech in financial year 2022, as we expect around a 10 to 12% price increase in the first quarter in financial year 22. This will basically enable the company to maintain current margins, even though aluminum prices have increased globally. This, together with single-digit interest rates, increasing demand for its product, we expect a higher capacity utilization for the company. Therefore, we are forecasting a 18.5% increase in profit attributable to shareholders in FY22. Moving on to Lanka Tile, as we mentioned in the presentation, Lanka Tile has exhausted its built-up inventory. So even in Q4 of FY21, we expect a Q-on-Q decrease in earnings, slight decrease. But in financial year 22, we're expecting a 15% reduction in revenue and an 8% reduction in earnings. But when it comes to Lanka Volatile, the company still has built up inventory to cater to excess demand in financial year 2022. In addition, Unideal packaging performance was very good in financial year 21, and we expect that to continue in financial year 2022. So these two should offset the reduction in profitability coming from subsidiary Lanka Tile, and earnings should be more or less in line with financial year 2021. With regards to RCL, what's the catalyst for growth for RCL is going to be both tiles as well as the sanitary segments. So the sanitary segment is expected to increase contribution by around 30% in terms of profitability. At the same time, the tile segment management are looking at various efficiencies to be brought in, and the product portfolio change from certain low margin items to high margin items. That should result in around a 5% growth in consolidated earnings in FY22. So to answer your question on sustainability, we do expect RCL and PARQ to outperform financial year 21 earnings in financial year 2022. LWL earnings to remain flat, although quite high compared to historical figures, whereas Lanka Tile, the earnings to slightly reduce by 8%. With regards to why we have assigned higher multiples compared to historical multiples, there are a few reasons. Looking back historically, the PEs were quite low because the demand for construction materials really reduced the last 3 years or so. So that resulted in sales coming down significantly. Then there was quite a bit of pressure on price from low price imports, resulting in erosion of margins. So these factors have changed in the current context with the single digit interest rates. Demand actually exceeds supply. Then with the current import restrictions, as well as various increase in cess to protect additional to provide additional protection for the local manufacturers, we expect margins to be quite strong going forward. So for that reason, we do expect the companies to trade at higher multiples compared to historical figures, but at a lower, at a discount to the broader market multiples. So we have assigned a discount compared to the broader market multiple of 10.56 for all four counters. So we think those, for the reasons stated earlier, the multiples to be justifiable.
Thanks, Asif. One of the other questions that have come up at the moment, as a concern that most investors have at the moment is the possible impact of the pandemic to these tile companies. As most people categorize this as a third wave, the infected numbers are on the rise, and people are anticipating extended lockdowns. So given these circumstances, how do you think such a situation will affect the tile sector? Divya, would you like to answer that question?
Yeah, sure. So actually, the initial lockdown, I think it was in March, did affect the first quarter performance. However, the subsequent lockdown that took place in October, which did affect the Gampaha district where most of these manufacturing outfits are located, by then they had the necessary protocols and there was actually minimal disruption to the operations. So we are not too worried in terms of supply side. We believe that the manufacturing outfits will continue operating despite the lockdowns. On the demand side, though, there could be an impact from a distribution perspective, and certain distributors may be impacted. But again, we believe that in the next quarter, there will be pent-up demand. This trend has been witnessed actually through the first and the second lockdowns. So we don't believe that there will be too much of an impact to the sector.
Right. Thanks, Divya. There are a few questions which have, a few more questions which have come up. There's a question on the there's a question on the tax structure. The question is how the tax reversals on manufacturers would affect these counters. Hasita, Divya, would you like to, one of you all can take up that question?
Sure. When actually looking at the tax structures, the revised cess has been imposed for importation. Actually, there's been an increase from what was charged previously. So previously, I think cess was at about 50% or 183 per unit, while now it's at 50% or 490 per square meter. So we believe that all of this has been imposed, keeping in mind and supporting the local manufacturers. So we believe that the local manufacturers are somewhat protected. And even at a later date, when imports do open up, they will remain competitive.
There's another question on the price advantage that they've been enjoying, the tile companies, given especially under the import restrictions. So since the import restrictions have been relaxed to some extent, does it mean going forward that they can't make supernormal profits, but only normal profits? Hasita, would you like to answer that question?
We don't really, so okay, let's look at it two ways. One is the sanitary ware segment, the other one is the tile segment. Since the tile segment contributes more than 70% for RCL and around 60% for the other two, for tile and Lanka wall tile, we'll talk about that. So even though there was talk of the import ban being lifted on the segment, it didn't really happen. So the local manufacturers still have protection in terms of import bans, but once the import bans are lifted, there will be the higher cess that applies. And since it's linked to the size of the tile and not to value, that will really reduce under invoicing from certain importers. So we don't really expect we don't really expect the imports to be competitive compared to the local manufacturers for a couple of other reasons as well. One is freight charges have increased significantly. The government has imposed a 180-day credit period required from importers as well. Most of the smaller importers wouldn't be able to raise that sort of finance from the banking institutions. So to answer your question, we don't really see a big impact coming from the imports being lifted eventually. And we expect the companies to maintain its margins in the foreseeable future.
Also, just to add to that, some of the larger importers have tied up with RCL and Lanka Tiles for long-term sort of OEM contracts. So we believe that these companies will use the importers as a sort of an additional distribution channel.
There's a clarification on LWL's expansion plans. There was a news about LWL planning to export tiles to USA. Is it happening now?
So I think with COVID striking the US as well in a big way previously, the company put those plans on hold. And since demand is outstripping supply locally, they are currently concentrating on serving the local market. So the US distribution is not really in place at the moment.
Hasita, one of the concerns that I would like you to maybe reiterate would be the plans, the expansion plans, the capacity expansion plans for these companies, and what type of expectation do you all have on the demand patterns for future years, assuming that the current economic conditions doesn't change drastically?
Sorry, Shihan, I didn't really catch you there. Can you repeat that question?
Yeah. Would you like to reiterate on the capacity expansion plans of these tile companies? On side, what type of demand patterns do you all expect for future years, assuming the current economic conditions don't change drastically?
Okay. So as Divya mentioned before in the presentation, before the import ban, I think the local manufacturers serve about 53% of demand. With the import ban, the local manufacturers are supplying around 93% of supply. I mean, 93% of demand. But obviously, there's an unserved element as well at the moment. So once RCL as well as Lanka Voltile adds additional 15,000 square meters per day, we expect the local manufacturer to serve around 95% of total demand. So we expect that to have a favorable impact on the company's revenue as well as profitability from financial year 24 onwards.
Right, and there's another question on asking for on your opinion about whether these import bans will remain the same, or do you all think that it could get relaxed further and further in the coming years?
Having spoken to the certain industry personnel, the expectation is the import ban to be in place until the end of financial year 2022. But even if this import ban is lifted, the increase in cess will kick in. So our expectation is for the import ban to be in place until financial year 2022. But even though it is lifted, we still expect the local product to be way more competitive compared to imported products. So we don't expect we don't expect the margins to erode even if the import ban is lifted going forward.
There is another interesting question on since Valuable One is holding, all these companies are coming under the umbrella of Valuable One Group. What do you all think about the impact to Valuable One Group and its valuations based on these tile company performances?
Unfortunately, Valuable One isn't in our coverage at the moment. So I don't want to really comment on the target price and the associated valuations for the company. But obviously, from the tile sector itself, the contribution towards Valuable One will be significant. But in terms of the fair value for Valuable One, we don't have the information at hand to answer that.
There's another question on competitors or new players rather. Will there be new players joining the market or any investment incentive for new players with Middle East domestic workers losing jobs and future expectation of larger pool of workers will be in Sri Lanka? So I believe the question must be mostly on whether we are anticipating any new players to come into the tile sector market.
Sorry, I didn't really understand your question. Can you just repeat that again, Sharon?
Yes, there's a question on whether we are anticipating any new players to join the market, the tile sector market.
All right, okay. Well, at the moment, obviously for the tile sector, the initial capex to set up operations is quite significant. And to build a brand and sort out the various requirements is time consuming. It takes quite a bit of time to set up as well as build a brand name. At the moment, we aren't aware of any new players setting up shop, but we do expect like the unlisted players like unlisted player like Mac Tiles to increase capacity as well to serve local demand. So I think it's the existing players that will expand and cater to the existing demand at the moment. But on the sanitary ware segment, we do expect a few new players to enter the market. But compared to the tile segment, the contribution to revenue and margins is relatively lower for the sanitary ware segment. So we don't really expect a massive impact to materialize to our sales earnings.
Okay, so seems we have covered most of the questions. So therefore, I think we can wind up today's presentation on the tile sector. Thank you, Hasit and Divya, for your valuable insights again. And on behalf of Capital Trust Research Private Limited, I wish to extend our sincere thanks for your participation, and we hope to see you soon at the next webinar. We will be having a series of webinars moving forward, so looking forward to seeing you all there as well. Have a nice day. Thank you.
If there are no further questions, I would now like to close the webinar. We have emailed and WhatsApp the tile sector update report to our clients. If you do not get our research reports, please send a WhatsApp to note 777-233-633. On behalf of Capital Trust Research Private Limited, I wish to extend our sincere thank you to our staff for organizing this webinar and for our valuable clients for their participation. Hope to see you soon at our next webinar. Have a nice day. Thank you very much.